Hello learners, welcome to Drishti CUET undergraduate program and I am your mentor Shashank welcoming you all in today's session. So learners, in today's session I will be discussing with you an important topic, and this is an important topic because this topic not only relates with the demand and supply of money in economy, but this topic also relates with the inflation. And the topic that I am going to discuss with you is the RBI and monetary policy. And from RBI and monetary policy, my dear learners, every year the question comes in your examination. So for every year the question comes from this particular topic. So today in this session I will be discussing with you, that is the RBI and monetary policy. First of all guys, in this session I will be discussing with you RBI and then we will discuss the monetary policy of RBI. So let's start with the Reserve Bank of India and RBI. You all know the full form is Reserve Bank of India. So first of all guys, I will be discussing with you the introduction of Reserve Bank of India. So Reserve Bank of India, what type of bank it is? It is an apex bank in the country. That means it regulates the whole banking system. In RBI, the individual or any company cannot open any type of account. So you will find that guys, RBI is not a scheduled commercial bank, it is a regulatory bank. So first of all, what type of institution it is? So it is a central or apex bank of India. So central or apex bank of India is RBI, and that regulator of banking system and money market. So that regulates the banking system and money market. Money market guys, it is a short term lending market. So it's a short term debt market, that is the money market. And RBI also regulates the banking system of the India as well as it also regulates the money market. Now guys, before RBI, since RBI guys it was established in year 1935, so before RBI, do we have any type of regulatory institution that used to regulate the banking system? So the answer is yes. So before RBI guys, in year 1921 there was a bank that was called as, there was a bank that used to regulate the banking system. So before RBI, banking system of India was regulated by which bank? That was established in year 1921. So that was established in year guys 1921, and the bank that used to regulate the banking system of India before the inception of RBI was which bank? So guys, before RBI, banking system in India was regulated by a bank that was established in year 1921, and the name of the bank was Imperial Bank. So the name of the bank was Imperial Bank of India, and this Imperial Bank of India used to regulate the banking system before inception of RBI. Now guys, what happened in 1926? A committee was formed. The name of the committee that was Royal Commission on Indian Currency and Finance. So Royal Commission on Indian Currency and Finance, that was being established, and it was under the chairmanship of Sir Edward Hilton Young. So that was under the chairmanship of Sir Edward Hilton Young. Therefore, this committee is popularly known as Hilton Young Commission. Therefore, this committee was popularly known as Hilton Young Commission. Because the chairperson was Sir Edward Hilton Young. So this commission was popularly known as Hilton Young Commission, that recommended that the Imperial Bank is not able to perform properly the function of central bank or apex bank. Therefore, India needs a separate central or apex bank to regulate the whole banking system. So guys, once the report was being laid, so finally, first of all, the report was rejected. First of all, what happened ki the report was rejected. Now once the report was rejected, it was after few years, it was again submitted to the it was again submitted, and with few modification the report was being passed. So with few modification, report was being passed. So now guys, what happened ki after passing off of the report of Hilton Young Commission, an act came that was called RBI Act 1934 was established. So RBI Act 1934 was established. So RBI Act 1934 was established, and on the report of RBI Act 1934 on 1st April 1935, RBI was established. So on the report of Reserve Bank of India Act 1934, RBI was established in year 1935. So RBI was established on 1st April 1935. Now my guys, first of all, that was through RBI Act 1934, and it was established where in India? So it was established initially in Calcutta. So it was established initially in Calcutta, but in year 1937, the headquarter of RBI permanently shifted to Bombay. Permanently shifted to Bombay. So the headquarter of RBI, my dear learners, that was permanently shifted to Bombay. So that I have discussed with you there. Okay, first of all, RBI, what type of bank it is? So it is the central or apex bank of the country, and it was established on 1st April 1935 through RBI Act of 1934. And initially guys, it was established as a joint stock company with the initial capital of 5 crore rupees. But at that point of time, it was held by private entities. In 1949, it was nationalized. So initially guys, the head office of this organization was in Calcutta, but in 1937, the headquarter of RBI was shifted to Bombay, and it was permanently shifted to Bombay, and in 1949, my dear learners, RBI was nationalized. So RBI was nationalized by Government of India in 1949. Now what is the meaning of nationalization? Guys, nationalization simply means when the majority of the shareholding means 51% and more. 51% and more, that was being held by when it is held by Government of India, so that is being called called that is called nationalization. So when majority of the shareholding is held by Government of India, that is called nationalization. But in RBI, 100% shareholding is held by Government of India. So 100% shareholding is held by Government of India. Therefore, it is completely nationalized. And other than RBI, the 100% shareholding of Government of India, it is in NABARD as well. So earlier guys, NABARD has few percentage of share with RBI. So what happened? RBI transferred that share to Government of India. Now guys, 100% shareholding of RBI and NABARD is with Government of India. So earlier it was with RBI, now it is with NABARD plus RBI. In both of these financial institutions, the 100% shareholding is with Government of India. So it was completely nationalized by Government of India, that is 100% shareholding is with Government of India. And guys, before and other than India, my dear learners, RBI worked as a central bank for two other countries. So this question came multiple times in different examination. Other than India, so that is other than India, RBI worked as central bank for two financial institutions. One is other than India, one is for Myanmar, that was earlier known as Burma, and next is for Pakistan. So other than India, RBI worked as a central bank for Myanmar and Pakistan. So other than India, RBI worked as a central bank for Myanmar and Pakistan. For Myanmar, that was earlier known as Burma, till April 1947, and for Pakistan till June 1948, RBI worked as the central bank. I hope it is clear to all of you. Other than this, guys, the first RBI governor was a British person. So it was established during the time of British time period. So the first RBI governor was Sir Osborne Smith. Osborne Smith, he was the first RBI governor. He was British. Other than this, the first Indian RBI governor, first Indian RBI governor was C.D. Deshmukh. That was Chintaman Dwarkanath Deshmukh. He was the first Indian RBI governor. And first deputy governor of RBI, who he was? So first deputy governor of RBI was Sir James Taylor. So first deputy governor RBI was James Taylor, and first Indian RBI governor, first Indian RBI deputy governor, who was he? So he was Sir Sikandar Hayat Khan. So he was Sir Sikandar Hayat. So he was Sir Sikandar Hayat Khan. He was the first Indian Deputy Governor of RBI. So Indian Deputy Governor of RBI, first Indian Deputy Governor, that was Sir Sikandar Hayat Khan. Other than this, guys, the present RBI Governor is 26th RBI Governor, that is Mr. Sanjay Malhotra, and he is newly appointed. That means he is appointed in December 2024 by Government of India for a period of 3 years. So he is appointed by Government of India for a period of 3 years. And the term of the governor can also be extended by the term of governor can be extended by Government of India as well. So Government of India can increase the term of governor or can extend the term of governor. Is that clear to all of you? So is that clear to all of you guys? Then do let me know. Now guys, first of all, let's discuss some important pointers about uh, RBI governor. So let's discuss some important pointers about RBI governor. So first of all, guys, who was the RBI governor when India became independent? So it is said that when India became independent, who was the RBI governor? So at that point of time, RBI governor was Chintaman Dwarkanath Deshmukh. So he was the RBI governor when India became independent. So let's discuss some important pointers about RBI. So this question is being asked once in a banking examination. The RBI governor when India became independent. So that was C.D. Deshmukh. That was C.D. Deshmukh. And he was the first Indian RBI governor and overall third RBI governor. So first Indian, overall third, because After Sir Osborne Smith, James Taylor became the governor, then C.D. Deshmukh. So he was overall third and first Indian RBI governor. So he was the person when partition happened. So second is the longest serving RBI governor. So who was the longest serving RBI governor? And the longest serving RBI governor was Sir Benegal Rama Rao. So Sir Benegal Rama Rao, he was the longest serving RBI governor. So Sir Benegal Rama Rao. So Sir Benegal Rama Rao, he was the longest serving RBI governor. He was the fourth RBI governor and he served for 7 years, 147 days. So he served for 7 years, 147 days. He was the longest serving RBI, 7 years, 197, not 47. So he served 7 years, 197 days. Then we have the shortest serving RBI governor. Shortest serving RBI governor. So who was the shortest serving RBI governor? So shortest serving RBI governor was 16th RBI governor. So it was 16th RBI governor who was the shortest serving RBI governor, and that was Mr. Amitabh Ghosh. Amitabh Ghosh, he was the shortest serving and he was the 16th RBI governor, and he served only for 20 days. He served only for 20 days. Other than this, the RBI governor who later became the Prime Minister of India, that was 15th RBI governor, and that was Dr. Manmohan Singh. So now he is no more. So the RBI governor who later became Prime Minister of India, that was Dr. Manmohan Singh. And Dr. Manmohan Singh was the 15th RBI governor who later became the Prime Minister of India. Dr. Manmohan Singh was the governor, former RBI governor who later became the Prime Minister of India, and he served for 2 years, 120 days as RBI governor. And he was 15th RBI governor, served as 2 years, 120 days as RBI governor. And till now, my dear learners, none of the female they have become RBI governor. So till now, none of the female, so that you can note it down, till now, none of the females they have become RBI governor. So till now, guys, none of the females they have become RBI governor, but they have become deputy governor. So first female deputy governor of RBI, that was who she was. So first female deputy governor of RBI, who she was. So first female deputy governor of RBI, that was Mrs. K.J. Udeshi. K.J. Udeshi, and she was the deputy governor from 2003 to 2005. So Mrs. 𝗕cie𝗂𝗍𝘀𝗧, she was the first female deputy governor of RBI. So I hope, my dear learners, is that clear to all of you about the important pointers of this Reserve Bank of India, that is about the RBI and about the governors and deputy governors. Now guys, let's discuss about the Central Board of Directors. So Central Board of Directors. Central Board of Directors, guys, this is the brain of RBI and this is located in Mumbai. So Central Board of Directors, that is located in Mumbai. So the number of directors in Central Board of Directors is 21. So the number of directors in Central Board of Directors is 21. And if you will see the number of directors in 21, so that this will be divided into official directors and non-official directors. Official directors total we have 5 and non-official director total we have 3. And which are the official 5? So one is the governor and 4 deputy governors. So one is governor, 4 is deputy governor, they are official directors, and non-official director 10 plus 4 plus 2. 10 plus 4 plus 2. 10, they are nominated by Government of India. So 10 directors, they are nominated by Government of India from different fields. 4, they are the directors of 4 local boards of RBI. So they are the directors of 4 local boards of RBI, and 4 local boards where they are. So they are in the 4 cosmopolitan cities. This is Delhi, Mumbai, Kolkata, Chennai. So Delhi, Mumbai, Kolkata, Chennai, these are the 4 local boards of RBI. So the directors of 4 local boards of RBI, they are in this non-official director, and 2 are appointed by Ministry of Finance. So 2 are appointed by Ministry of Finance. So these are the Central Board of Directors and this is called the brain of RBI. So this is called the brain of Reserve Bank of India. Is that clear to all of you? Which is called the brain of India. So this is the Is that clear to all of you guys? So do let me know. I hope guys, is that clear to all of you about the Central Board of Directors? Now let's come to the functions of RBI, what exactly RBI does. So let's discuss about the functions of RBI. So let's discuss about the functions. Let's discuss about the functions of RBI. First is Bankers Bank. So RBI is called Bankers Bank. Reason is this: every bank every bank opens 2 type of account in RBI. One is current account and second is SGL account, that is subsidiary general ledger. Therefore, it is called Bankers Bank. Next is banker to the government. Banker to the government. So RBI works as a banker to the central government कि whenever the government of India they have to raise the fund, they take the fund from RBI. So they say to RBI to raise the fund. Other than this, third is regulator of banking system and money market. Regulator of banking system and money market. Fourth is the issuer of currency. Issuer of currency. So RBI issues the currency. So issuer of currency. Other than this, RBI works as lender of last resort. Works as LOLR. LOLR means lender of last resort. So RBI works as lender of last resort to the government of India. Sorry, for the banking system. So RBI worked as LOLR. LOLR means lender of last resort. That means that whenever there is a situation of crisis, when there is no one to help the scheduled commercial bank, so RBI comes forward and helps the scheduled commercial bank. So after, due to this activity, RBI is called lender of last resort. So RBI is called lender of last resort because whenever there is a situation of emergency, RBI comes forward and arranges the money for that, and that therefore it is known as lender of last resort. Is that clear to all of you? Is that clear to all of you guys? Then do let me know. So this is all about the functions of RBI. Now guys, I will be discussing with you the next thing, that is the monetary policy. So now guys, let's discuss about the monetary policy. First of all guys, if you talk about the whole policy of India, so in India guys, there are two major policies which is being drafted. So in India guys, you will find that there are two major policies which is being drafted. So one is called monetary policy and second is called fiscal policy. One is called monetary policy and second is called fiscal policy. Monetary policy guys, it is always derived from the word money. So what type of policy it is? So the policy that regulates demand and supply of money in economy. So the policy that regulates the demand and supply of money in economy is called monetary policy, and fiscal policy that regulates the income and expenditure, the income and expenditure that regulates the income and expenditure of the government is called fiscal policy. So monetary policy guys, that regulates the demand and supply, whereas fiscal policy that regulates the income and expenditure. So monetary policy, it is regulated by the central bank. So monetary policy guys, it is always regulated, or it is always formed by central bank, not regulated, it is formed by central bank. And fiscal policy is also formed by this is by government. So fiscal policy, it is always formed by government, whether it is central government or state government, and fiscal policy is formed in the form of budget. So fiscal policy, it is created in the form of budget. So budget, it is being prepared by central government and also for the state government. So fiscal policy that that is did so that is through the that is in the form of budget, whereas monetary policy, it is always formed by the central bank of the country. And in India, guys, the work of central bank is did by RBI. So RBI performs the work of central bank. So it is did by the Reserve Bank of India. So it is did by the Reserve Bank of India. I hope it is clear to all of you. Is that clear, guys? So I hope, guys, is that clear about the two major policies, monetary policy and fiscal policy. So today, guys, I will be discussing monetary policy with you. First of all, guys, what exactly is the monetary policy? That I have told you कि the policy that regulates. Regulates means कि to increase or decrease. So regulate simply means increase or decrease. Increase or decrease the demand and supply of money in an economy. To increase or decrease the demand and supply of money in economy, it is called monetary policy. So the policy, guys, that increases or decreases the demand and supply of money in economy to maintain the financial stability, and it is did to maintain. So it is did to maintain financial stability. Financial stability in market. So it is did to maintain the financial stability in market. So the policy that regulates the demand and supply of money in an economy to maintain the financial stability in the market, that is called monetary policy. And guys, monetary policy, it is prepared once in a year. So it is prepared generally in the month of April. So once in a year. So fresh monetary policy. Fresh monetary policy comes in. Fresh monetary policy is introduced in month of April. In month of April every year. So in month of April every year, and it is revised on every 2 months, and it is revised in every 2 months. So according to the market condition, according to the situation of the market, that is revised in every 2 months. So it is revised in every 2 months after as per the need of the market. So as per the need of the market, it is revised after every 2 months. So that is sure it is revised after every 2 months. So what exactly happens once the rates they are increased or decreased, that totally depends upon the market condition. And monetary policy, guys, who revise the rates of monetary policy? So monetary policy committee of RBI prepares and revise the rates of monetary policy. So monetary policy, guys, it is prepared and also it is revised by a committee, and this committee is called Monetary Policy Committee of RBI. So this is called Monetary Policy Committee of RBI. So I hope, my dear learners, is that clear to all of you what exactly is the monetary policy and what is the when monetary policy is formed, who revises and declares the rate of monetary policy. So now, guys, I will be discussing with you the committee, that is Monetary Policy Committee. Monetary Policy Committee, in short, it is written as MPC, Monetary Policy Committee, and it was constituted after amending section 45 ZB of RBI Act 1934. So it was constituted after amending section 45 ZB of RBI Act 1934, the Monetary Policy Committee was constituted. And the number of members in Monetary Policy Committee, so the number of members it is 6, 3 from RBI and 3 from Government of India. And actually this RBI members, it is 1 plus 2. So 1 is always the RBI governor. So 1 is always the RBI governor and two other members of RBI. So it is 1 is RBI governor plus 2 other members, and RBI governor is the head of Monetary Policy Committee. And RBI governor, guys, is the head of Monetary Policy Committee. But the decision is not solely taken by RBI governor. So whatever the decision is taken, it is not directly by RBI governor. So it is said that the decision, it is taken through majority. So the decision of Monetary Policy Committee. Decision of Monetary Policy Committee is taken by RBI governor, is taken through majority. So the decision of Monetary Policy Committee is taken through majority. So the decision is taken through majority by Monetary Policy Committee. Is that clear to all of you? So whatever the decision is taken by Monetary Policy Committee, it is taken through majority. I hope it is clear to everyone. And whatever the majority goes in the favor, that decision is implemented. So the decision is taken through majority, and that decision is implemented. So that decision is implemented. So that decision is implemented by MPC. Now guys, let's discuss about the rate of monetary policy. So let's discuss about the rates of monetary policy. Is that clear to all of you? So now guys, let's come to the rates of Monetary Policy Committee. Now guys, overall, if you will see the rates of monetary policy, there are two types of methods. So there are two types of methods which is being used. First is called qualitative tools. So methods that you can say the first of all, there are methods of the rates of RBI. So you will find that the tools of monetary policy. So first of all, let's discuss the tools of monetary policy. Let's discuss about the tools of monetary policy. Guys, generally there are two types of tools of monetary policy. One is quantitative tools, another is qualitative tools. Now guys, quantitative tools are those tools that involves number and figures. So the tools that involves number and figure, this is called quantitative tools. So the tools involving number and figures, this is called quantitative tool, and qualitative tool is did for the quality improvement. Quality improvement by RBI, like moral suasion, selective credit control, credit rationing, and direct action. Moral suasion, guys, it means ki in which sector what type of loan has to be given. Then selective credit control, then credit rationing, direct action. Direct action means if any financial institution that violates the code of conduct, that violates the rules of RBI, then RBI can punish that financial institution directly. This is called direct action. Other than this, guys, quantitative tool, you will find there are two types of tool. One is called reserve ratios. Reserve ratios and policy rates. So reserve ratios and policy rates. So now, guys, what I am going to discuss in the next slide, that is about the quantitative tool, because in examination you will find the question from quantitative tools. Generally they can ask you ki which of the following is quantitative, which of the following is qualitative. So that which is not quantitative, it will be qualitative. So it will be easier for you to eliminate the option and arrive at correct answer. So let's discuss about the tools of monetary policy or the rates of monetary policy, and it is a part of quantitative tool. Is a part of quantitative tool of monetary policy. It is a part of quantitative tool of monetary policy. Now, guys, there are two types of rates. One is called reserve ratio, as I have told you, and another is called policy rates. So reserve ratios, guys, that is compulsory to be maintained by scheduled commercial bank. These are compulsory ratios which has to be maintained by scheduled commercial bank. Therefore, they are called reserve ratio, out of which one is cash reserve ratio. This is called CRR, and another is SLR. And the policy rates, you have repo rate, reverse repo rate, bank rate, marginal standing facility. These are four conventional rate. But in year 2002, RBI introduced one more rate, that is called SDF, that is standing deposit facility. So standing deposit facility, it is being introduced in RBI in year 2022. So RBI introduced one more policy rate. It is called SDF, standing deposit facility. This was introduced in year 2000. This was being introduced in year 2022 by RBI. This is called SDF. So I hope maximum of you might be knowing about this rate, but some of you might not be knowing about SDF. SDF, it is a bit technical, but I will try to make it as simple as I can so that you can understand properly. Now, first of all, guys, let's start our discussion with the cash reserve ratio. First of all, guys, what is CRR? CRR stands for cash reserve ratio. Cash reserve ratio. So what it is? So it is the percentage of NDTL. NDTL stands for net demand and time liability. Net demand and time liability that every bank has to keep with RBI. Generally, every bank means, guys, that is the scheduled commercial bank. So this is scheduled commercial bank. This is scheduled commercial bank are those banks which are mentioned. So banks which are mentioned, banks which are mentioned in Schedule 2 of RBI Act 1934. So they are called scheduled commercial banks. So generally, guys, this CRR, it is maintained by scheduled commercial bank and is kept with RBI in form of cash, and it is maintained on daily basis. So it is maintained on daily basis. So it is maintained on daily basis, my dear learners, and it is kept with RBI on fortnightly basis. So it is maintained on daily basis, but it is not maintained by the branches of the bank. It is always maintained by the headquarter, and it is kept in with RBI on fortnightly basis. But no interest is paid by RBI. No interest is paid by RBI on CRR. So you might be thinking if it is maintained on daily basis and is kept with RBI on fortnightly basis, that is the money of scheduled commercial bank. So do RBI pay interest on CRR? So the answer is no. RBI does not pay interest on CRR. Earlier it used to pay when the situation of banking system was pretty bad in India. So now they have stopped paying any type of interest because it's a compulsory obligation, because this is the, you can say it works like a security of scheduled commercial bank before RBI. Whenever RBI, whenever the scheduled commercial bank wants to take loan, so they can take on the behalf of CRR, and if the bank gets dissolved due to any circumstances, then still the you can say investment of the customer, it is safe. So it is just like a security. So it works like a security purpose. So first of all guys, what is NDTL? That is net demand and time liability. First of all guys, the NDTL, what it means the difference between total deposits minus total withdrawals. Total deposit minus total withdrawals by a bank in a day. So whatever the amount is deposited in a bank in a day, and whatever the amount of the withdrawals that was did by the customers from that bank, so the difference between the total deposit and total withdrawal, that is technical, that is called NDTL. So that is called NDTL, that is net demand and time liability. And one thing you should note that guys, ki the NDTL should not go in negative because, or zero, because once NDTL becomes zero or it goes in negative, the bank will collapse. The bank will collapse. So NDTL should not go in negative or even cannot become zero. So that is a very big concern for the bank if the NDTL becomes zero. So it is the total difference between total deposit minus total withdrawals by a bank in a particular in every day. So that should be positive. So NDTL should always be positive. So it is the percentage of NDTL that is kept with RBI by scheduled commercial bank in form of cash, and it is maintained on daily basis. For example guys, let's suppose the present rate is 4%. Just I am giving an example. Let's suppose the rate is 4% of NDTL. So for example, let me give you an example. For example, the NDTL of a bank is 100 crore. Then what should be CRR? So for example guys, CRR, it is 4% of NDTL. Then 4 crore should be kept in reserve by RBI, by scheduled commercial bank for RBI. So it is being parked on daily basis. So CRR, it is maintained on daily basis and is kept with RBI on fortnightly basis. So I hope it is clear. Now, first of all guys, RBI do not pay any type of interest on CRR. So whatever the CRR is deposited by scheduled commercial bank before RBI, RBI is not bound to pay a single rupee interest for that. I hope it's clear. Next is SLR. SLR means statutory liquidity ratio. Statutory liquidity ratio guys, what it is a percentage of NDTL. Again NDTL, the same thing, which is maintained by scheduled commercial bank with itself. So SLR is maintained with itself, not for RBI. It is maintained it with self in the form of gold, cash and government securities. So SLR guys, it is maintained in the form of gold, cash and government security. So it is maintained, SLR, it is maintained by bank with themselves, and SLR cannot exceed 40%. So SLR, you cannot exceed 40%. So there cannot be more than 40% SLR can be deposited by scheduled commercial bank. So for example guys, this overall, why it is maintained in gold? Gold, because it is the most liquid asset. So it is the most liquid asset. So most liquid Although the cash is the most liquid asset, but out of the gold, cash and government security, why it is maintained in government security? Because government security, it has no risk factor. So risk factor on government security is 0. So risk factor, it is government security is 0. Although guys, the cash is considered as the most liquid asset. Cash is considered as the most liquid asset, but gold is also very liquid. After cash, it is the gold, because you can easily sell the gold in the market. Although the cash is considered as the most liquid asset, but it is gold, because once after cash, it is gold, because you can take gold and you can sell easily in the market. So after cash, the most liquid thing is gold. Is that clear to all of you? So SLR and CRR, it is compulsory to keep CRR and SLR. Why SLR is kept? To show that the bank is to show the solvency of the bank. So SLR, why it is maintained? To show the solvency of the bank. And here bank again means scheduled commercial bank. SCB means scheduled commercial bank. So SCB means scheduled commercial bank. So to show the solvency of the bank, CRR and SLR, they are maintained. CRR is maintained with RBI, SLR is maintained with themselves. I hope it is clear to all of you. I hope it is clear to all of you. I hope it is clear to all of you. Now guys, let's come to the third thing, that is called the repo rate. Repo rate guys, it is the rate at which RBI lends short-term loan to the scheduled commercial bank. So repo rate guys, it is the rate at which RBI lends short-term funds to the scheduled commercial bank. So this is for the scheduled commercial bank, and it is did against the government securities, And government securities guys, it is also known as gilt-edged security. Government security, it is also known as gilt-edged security. Why it is called gilt-edged security? Because the risk factor is 0. Why government security guys? It is served as the collateral. Because the risk factor is 0. Because the risk factor is 0 guys, therefore repo rate, it is for the short term lending rate. So it is up to 90 days. So it is a short term lending rate. So it's a short term lending rate, that is called repo rate. Now guys, what is reverse repo rate? So repo rate, you understood. What is reverse repo rate? Now what I have seen guys, ki many people, they say, in fact I have seen in some of the books as well. So reverse repo rate is the rate at which commercial RBI takes loan from the commercial bank. That I have seen in multiple places, this definition, in fact in some of the books as well, but it is completely wrong definition. Reason is this, ki RBI has power to issue currency. So if there is need of currency for RBI, then RBI will print the currency and will keep with it. And RBI follows the minimum reserve system to print the currency, that is 200 crore is always maintained with RBI, out of which 115 crore is of gold and 85 crore is of forex, that is foreign currency. So RBI never takes loan from any other financial institution in India, because RBI has power to print currency. And if RBI has power to print currency, then why RBI will take loan from any other financial institution for its working? So what happens exactly? It is the rate given by RBI on which scheduled commercial bank deposit their surplus fund. It is the rate at which scheduled commercial bank deposit their surplus fund with RBI against government security. So this is did against government securities. So it is the rate given by RBI on which the scheduled commercial bank park their surplus fund with RBI against the government security. Now see what happens. in reverse, in repo rate, the commercial bank gives the government security to RBI to take loan. So in repo rate, what happens? The scheduled commercial bank just gives government securities to RBI for lending, for lending. Now in reverse repo rate, what it happens, when scheduled commercial bank park their surplus fund, then what used to happen ki RBI gives them government security. So RBI provides them government security. So now guys, when scheduled commercial bank, they are parking their surplus fund with RBI. So what happens ki RBI gives government security to the scheduled commercial bank, that can be used further by scheduled commercial bank for taking loan or for any other purpose. Now here comes SDF, that is standing deposit facility. Here comes SDF, standing deposit facility. Here comes the SDF. Now guys, what happens in SDF? Here scheduled commercial bank park their surplus fund with RBI without collateral. Without collateral means without government securities. Now see what happens in SDF. Now what happens in SDF, that is standing deposit facility. Here the scheduled commercial bank parked surplus fund with RBI, but RBI says if in SDF I will not give you government security. So I will not give government security to the scheduled commercial bank as a collateral. So it is a collateral free agreement between scheduled commercial bank and RBI, that if scheduled commercial bank will park their surplus fund with RBI, RBI is not going to give them collateral. So RBI is not going to give them government securities. So that is called SDF. So SDF guys, it is always the rate of interest is higher. So for if you will compare reverse repo rate and SDF, the rate of SDF is higher. Reason, यहाँ government securities नहीं देना है. रिवर्स रेपो रेट पे देखो, यही टेक्निकल पॉइंट है जो स्टूडेंट्स को कंफ्यूज कर देता है एसडीएफ और रिवर्स रेपो रेट. देखो एसडीएफ जब भी चलता है तो दैट इज कोलैटरल लेंडिंग. यहां पर शेड्यूल कमर्शियल बैंक को आरबीआई कोलैटरल देता है, लेकिन वही जब एसडीएफ के जरिए शेड्यूल कमर्शियल बैंक को लोन लेना हो, आरबीआई शेड्यूल कमर्शियल बैंक को सरप्लस फंड पार्क करना होता है, तो उस कंडीशन में आरबीआई उसको कोलैटरल नहीं देता. और कोलैटरल नहीं देगा तो कंपनसेट कैसे करेगा? With higher rate of interest. Therefore, the rate of SDF is higher than reverse repo rate. Is that clear to all of you? So, is that clear to all of you guys? That the rate of SDF is always higher than the reverse repo rate. Reason is this: in SDF it is a collateral free lending. So, in SDF guys, it is a collateral free lending. So it is collateral free lending. So SDF park their surplus fund without collateral. So it is a collateral free deposit agreement between RBI and scheduled commercial bank. Between RBI and scheduled commercial bank. Therefore, guys, the rate of reverse repo rate, the rate of SDF is always higher than rate of reverse repo rate. So for example, at present, if I give you the present scenario, so the rate of SDF is 6%, whereas the rate of reverse repo rate. So the reverse repo rate, what it is? So it is just 3.535%. So it is 3.35% reverse repo rate. So reverse repo rate is 3.35%, that is reverse repo rate. Why the higher rate of interest is given? Reason is this, it is a collateral free agreement. Collateral free agreement between Reserve Bank of India and RBI. Sorry, between Reserve Bank of India and Scheduled Commercial Bank. There is no collateral agreement in case of SDF. Now banks, if they want to earn higher rate of interest, they can go for SDF. But if the situation of bank is pretty cool, then they can go for reverse repo rate as well. So both options RBI have given to Scheduled Commercial Bank. If you want to earn more interest, then go for SDF. And if you are okay with the existing rate of interest, that is 3.35%, you can go with reverse repo rate. Is that clear? So here it is a collateral free agreement between RBI and Scheduled Commercial Bank in SDF. Whereas in reverse repo rate, what happens when commercial bank park their surplus fund, RBI gives them government security against that fund. I hope it is clear to all of you. But in SDF, there is no collateral agreement between Scheduled Commercial Bank and RBI. Is that clear to all? So this is a slight difference between reverse repo rate and SDF. Therefore, the rate of SDF is higher than reverse repo rate. So at present that I am talking about the last monetary policy review, it is 6% for SDF and just 3.35% of reverse repo rate. So almost it is a difference of good difference between these two. Now come to the bank rate. Bank rate, guys, what I have seen this definition, that bank rate, it is a rate at which RBI gives long-term loan to the Scheduled Commercial Bank. That is a pretty old definition. That is a pretty old definition. Now it is not being used. So it's a pretty old definition, although it was correct, but now it is not being used. So what exactly is the use of the bank rate? So bank rate, it is used as a reference rate for penalty for non-maintaining CRR and SLR. So guys, CRR and SLR, they are maintained on daily basis. And if any bank fails to maintain CRR and SLR on daily basis, they are penalized by RBI. Now, how they are penalized? For day one, bank rate plus 3%. For day one, bank rate plus 3%. For day two, bank rate plus 5%. And on day 3, if it is not being maintained on day 3, then legal notice from RBI. And whenever, guys, any Scheduled Commercial Bank or any other financial institution, they faces penalty, when any Scheduled Commercial Bank or any other financial institution, they faces penalty, then the rate of the penalty is calculated with the reference of bank rate. Other than this, guys, bank rate, it is the rate at which the bills of exchange, it is rediscounted by RBI. So it is also called rediscounting rate. So it is the bills of exchange. It is when it is rediscounted by RBI, the rate at which the BOE, it is a negotiable instrument, guys. So BOE, it is a negotiable instrument. It's a negotiable instrument. So bank bills of exchange, it is a negotiable instrument act. And bills of exchange, it is mentioned under section 5 of Negotiable Instrument Act. So bills of exchange, it is mentioned under section 5 of Negotiable Instrument Act 1881. And Negotiable Instrument Act, we have 3 Negotiable Instrument Act: bills of exchange, promissory note and check. So bills of exchange, it is mentioned in section 5 of the Negotiable Instrument Act. I hope it is clear to all of you. Other than this, guys, next we have marginal standing facility. So marginal standing facility, guys, it is the rate of interest which RBI gives, at which RBI gives overnight loan to the scheduled commercial bank. So it is the rate of interest at which RBI gives overnight loan to the scheduled commercial bank. Overnight loan means just for a night. So overnight loan, guys, that means just for a night. And if I talk about this marginal standing facility, the rate of interest is pretty high. So rate of interest is around 6.5%. So at present, guys, the bank rate and marginal standing facility both are same. So at present is 6.5%. So it is the rate at which RBI gives loan to for the overnight period to the scheduled commercial bank. Now guys, you might be thinking ki why a scheduled commercial bank will take overnight loan from RBI? What's the need? Now it may be possible, guys, that there is a shortfall of or there is a shortfall of CRR, there is a shortfall in SLR. So if CRR and SLR are getting short, so it will invite penalty from RBI. Bank rate is 6.5 plus 3%, 9.5%. They will have to pay penalty to Reserve Bank of India. But if they will take loan from Reserve Bank of India for an overnight period, they have to pay only 6.5. So there is a flat difference of 3%, because at present bank rate and MSF both are same. It is 6.5%. So if there is shortfall of CRR and SLR, so why it is taken? So why? To maintain shortfall of CRR and SLR. So it is the primary objective. Other than this, guys, for example, a big customer came before bank and they want loan for a particular project for an overnight. On the next day they will return for also giving for this interbank borrowing. So that is interbank borrowing. It is did on the call money, and call money it is called on the basis of Mumbai interbank offer rate, that is called MIBOR. So what happens, guys, if a scheduled commercial bank, before scheduled commercial bank, any big customer comes and they want loan, and RBI and the commercial bank is not able to manage that much amount very quickly, so what they will do, so they can take the loan from Reserve Bank of India. So it is the method. So basically primarily it is used to maintain the shortfall of CRR and SLR, because once the shortfall of CRR and SLR happens, then RBI will impose penalty, and penalty that is the gap is 3%, because at present bank rate and MSF both are same, that is 6.5%. So what will happen if it is not maintained on the next day? Bank rate plus 3%, that means 9.5%, which is a very big amount. So in order to avoid the penalty of by Reserve Bank of India, so that is being used to maintain CRR and SLR short form and to avoid penalty. I hope it is clear to all of you. I hope it is clear to all, guys. Then do let me know. Is that clear to all of you, guys? So my dear, that was all for the today's session, and let's meet in the next session to discuss the next important topic.